How are you? We certainly appreciate you taking time to be here.
Oh, absolutely. Absolutely.
Well, is it getting to be 9? I guess it's about 9 o'clock, isn't it?
Yeah.
Okay, let's start off with the roll call. Jay Brown is here. David Mintz.
I am here. Thank you.
Tony Lappy, I've seen. Linda Laird. Hopefully Linda will come on in a few minutes. Never known her to miss a panel.
No, I'm here. Video
okay.
was
Hi, Linda.
Whatever.
Good morning, Linda.
Good morning.
All right. Bruce McDonald, I've seen. John Jensen, I've seen. Let's see. Is Ken Gill, we've seen. Ann Brady.
Yep.
Hi, Ann.
Morning.
Marguerite, are you here? Hopefully
Marguerite.
Yes, I'm here. I'm sorry. I was muted.
Okay, thanks, Marguerite.
Sorry.
Bob Walter.
Good morning, everyone.
Hi, Bob.
Good morning, Bob.
And Sandy Stillwell, which I saw Sandy earlier. So everybody is present, which is great. Our first order of business is always to approve the minutes from the prior meeting. We have minutes from our regular meeting that we held a month ago. Does anybody have any comment on the meetings?
No.
Minutes, rather?
No.
Okay, all in favor of approval, raise hand, say aye.
Aye.
Okay, Ken, do we have minutes from that special meeting that we held? I haven't seen them.
I have not been doing many minutes from the special meeting. I have recordings.
Oh, okay. That's fine. Thank you. Okay, first up on the agenda, we're going to have an update from our property appraiser, Matt Caldwell. Matt, we really appreciate you being here this morning and give us an overview of what's going on with the taxes and deletions and so forth. Our fire chief, Jeff Powell, is very interested in having you do this, so welcome.
All right, excellent. And how long do y'all want me to?
Well, you can have what you need. I've got slotted in a half hour.
Okay.
But
right.
if that's not enough,
I can turn it into longer, a 4-hour continuing ed if y'all want. You just let me know.
Well, we love to hear about taxes, but I don't know about 4 hours worth.
There we go.
Yeah.
All right, so let me do a couple of quick basic points so we're all operating from the same framework. You all know and recognize what we developed for the tax roll is based on January 1st. That's the value date that all of our numbers are developed, and also the situation of the property, who owns it, how it's being used, the condition is all based upon the January 1st status. That's the way it's judged for the entire tax year. There's only two departures from that paradigm, and they're both special tax breaks. One is for disabled veterans. They can begin to receive their particular tax break the moment they buy a property. And then the other one is the tax refund that many of our taxpayers went through last year. And so that is, again, tied to just the specific period of time following the disaster. So those 3 months at the end of last year, and only those 3 months applying just to last year's tax year. So when we talk about everything this morning, we're talking in the context of January 1st of this year, who owned it, what was the condition, just all the details about it are going to play out in what is shown in the tax roll. Now, the biggest vocabulary that seems to have tripped folks up is what the Department of Revenue, the State Department of Revenue, calls deletions. And deletions does mean the typical application is when something literally gets deleted from the tax roll, whether that's the house entirely, in a normal circumstance, you tear down the house, so we recognize the house is gone, or even the parcel, whether a split or combine has occurred, and so there's an actual tax folio that is gone from the system, and it has some impact on value at some level. obviously in a combine, you're going to delete and then add because you'll have a new value for this new bigger parcel. And the way that the Department of Revenue asks for all of that to be reported is in a kind of a progressive analysis with all of those additions and subtractions, and that ends up with a net change for the total value of whatever the taxing authority is, the county, the city, the special districts, in y'all's case out on CAPTIVA. And what is obviously unique about this year is not only do we have an extraordinary number of deletions, but deletions mean all kinds of things. It means from the awning on the front of the building that's now gone to a complete loss of the property. Some physical change has occurred in the property that resulted in a loss of value. So to give you some scale, countywide, our deletion count now, deletion impacted, again, understanding what I mean when I say that in total, about 19,000 condo units fall into this category. And then about, I have been saying 12,000, it's crept up to about 13,000 of, single family, mobile home, cooperative, everybody who's in a single owner context residentially. That's about 13,000 parcels. And then everything else, which is literally everything else, is about 1,800 parcel counts. That's all your commercial, all your multifamily, all your hotels, motels, etc.
Hey, can I ask you a question? Can I ask you a question? When you refer to deletion, and it's Bruce McDonald here, are you referring to a complete deletion or could it be partial?
Partial. So for Department of Revenue's purposes, they just want the total sum of all of the real property features that were in the 2022 tax roll that have now been deleted from the 2023 tax roll. And so again, that could cover from as small as the awning on the front of your house as a feature, all the way up to all the structures on the property. So it
does not include, Matt, it doesn't include landscape, is that correct?
Correct. Only items of real property that we value. Those of you know, I've got 20 years of real estate appraisal and private practice. You can make analyses of value for landscaping, particularly if you talk about historic features like banyan trees and whatnot. They have value, but they don't get captured in our tax roll process. When our tax roll process is developed, it's done at a mass appraisal scale. So you're not chasing the smallest variables. The mass appraisal model focuses on the biggest variables that matter, and we all know those. What's your view? How big is your house? How many bathrooms do you have? Do you have a pool or not? And where's your location? And once you get beyond 5 variables, get any statisticians in the room, you're just chasing slices that aren't going to make any difference to the whole. Our models go as deep as sometimes 10 or 12 variables, but landscaping it definitely isn't a mass scale implication. So you're not going to see that captured.
Okay.
Yep.
So if you say you lost your roof, would that be a deletion?
Yes, it will show up as a diminishment in the physical characteristics of the property. So it'll get captured as a slice of value. Now, in that case, in the individual features of a home, depending on it, like if you go and ask us for our reports, we have to be very specific about what we ask to be printed out. So if you called me and said, give me everything that's been destroyed, our data staff isn't automatically going to pull all of those depreciation factors in all the house, just the roof or just the front porch or just the damage to the pool cage. That's not going to get captured in that. If you just ask them in general terms, layman's terms, give me everything that got destroyed, they're going to pull a report that gives you everything where the building itself was gone.
Matt, could I just say, how does your office know that information? So, for example, if someone had 4 feet of flooding and lost half the drywall in the house and part of their roof, do you have someone going out to each of these properties, or you only know about that if someone asks for a tax abatement of some sort through the process that was set up earlier as a result of the hurricane?
Well, it's a combination. So I just so happened to be getting ready for Reese today and doing a presentation, and I will, let me see if the share screen will work. Share screen 2. This is a question I expect to get. Everybody see this PowerPoint now?
Yeah.
All right. So clearly this is a snapshot. This is the aerial from January of 22. We fly the county every single year. We don't use satellite imagery, not only because it's not proprietary, but also it doesn't give us the level of detail that we're able to achieve with an aerial flight. We can get down to 6 or even 4-inch resolution by having them flown ourselves. So we fly those every year. We try to do it in the first week of January so that it's contemporaneous with the value date. Last year, we flew an extra flight. We flew it 3 days after the storm. So the first thing we did, once we got stabilized for our staff purposes and we're back in the office probably about the second week of October, we had these delivered to us, and we began to do comparisons between the 22 aerial and the October 3 days after the storm aerial, and tagging all the properties that had obvious impact from the storm. And using that, you've probably heard me use the 100,000 parcel quote around. That's where we drew this lasso, essentially, of the geography we knew we would have to focus on for this tax roll, even more particularly than our normal responsibility. So taking all of that aerial data, and this is the overhead 2-dimensional snapshot. If you go to our website, if you go to your individual property, you can also click on the pictometry tab, and you can see a 3-dimensional picture. So when that aerial plane, and that's another advantage of flying it ourselves rather than satellite, it comes in and takes multiple angles from all 4 sides of the house. So we get not quite a Google Street View because it's obviously still overhead, but we got a 3-dimensional unit. So as the staff first went through and tagged every single property that you could see in the 2-dimensional layer had the potential for damage that needed to be addressed, then the field staff worked through November and December using those 3-dimensional views to see really properties that we not have to go visit. I mean, we started that first flush when you heard me back at the first talk about 10 and 15,000 properties that were totally destroyed or effectively totally destroyed. That was the result of going through the aerials and using the 3-dimensional identification to see we don't need to go visit this property personally because it's coming off the tax roll. And then what we did was take the reports as we started to process those tax refund requests, as well as just our general call to the community for their information. This is the current snapshot of all the confirmed. So this is people have reported to us that they experienced flood damage, and we have gone and field confirmed that is the case. We took this as well as all the information that everybody gave us, the fire districts, State Department of Emergency Management, the county, FEMA, etc., and we modeled the full impact that we should expect to see of some kind of effect from the flood throughout Lee County. And that led us to where we're at right now. This is our current snapshot. What are we clicking towards? This is a pretty heavy year. So to give you perspective, we got about 550,000 properties. We got to visit a property once every 5 years. So rough math, we got to do 100,000 touches every single year. And you can see from this report here, we're over 200,000 interactions now throughout the county. So I will definitely give some kudos to my staff because they've worked double time to do that. And then here's the stats I gave you all a minute ago about where we're at. And we closed out with about just shy of 19,000 refunds. So back to the question, how do we identify all of that? The first run was to use all the technology that we could, not only to make it more efficient, but we also didn't want to get in people's way, particularly in November and December. You were still working on recovery efforts. We didn't need our field staff driving around and make it even more difficult for everybody. But here's the reality. We fully expect that there are still a not insignificant number of homeowners who have not communicated with us. And that's just comparing this, what we've modeled as the likely extent of the impact versus what we've communicated with. There's still a delta there. And we think when we send out the trim notice here in a couple of weeks, we will get, our normal interactions after trim are somewhere probably between 8,000 and 10,000 property owners. I'm expecting we're going to have double that at least. That we'll have to field over those 3 weeks of trim. And then the heartbreaker will be the number of people that, and it happens every year, they ignore the trim notice and they don't call us until they get the tax bill in November. And by the time you get the tax bill, once trim closes in September, I lose all of my discretion. The only changes I can make at that point are those that are specifically authorized by statute, which is really limited to factual errors. We say you got a pool, but you don't have a pool. There's nothing to argue about there. So does that cover?
So the key point, Matt, the key point you're making is that you have to, if you don't agree with the valuation because you think you have, very significant damage, and you don't feel the property appraiser has got an appraisal that reflects that amount of damage, people have to react within a month of receiving their trim notice. Is that correct?
They have 25 days from the time it hits the mail. And we're right up against the deadlines for everything, just trying both to facilitate everybody that's impacted. We had a couple of districts yesterday. The deadline was last night to get us the millages, and a couple that were right at the deadline. So we should get it still on time out in the mail, or at least to the printer this week, Thursday, Friday, which puts it in the mail next week, which then puts the 25-day endpoint sometime around the second week of September. Yep. Yeah. Tony, you're on mute.
Okay, there we go. Hey, Matt, first of all, thanks for coming on. This is very helpful. The question I have is, you talked about destroyed, but you didn't talk about uninhabitable. Now, with contractors being overloaded as they are, many homes are being fixed up, but are still uninhabitable. How does the tax look at uninhabitable versus destroyed or damaged? How do you do that? You know what I mean?
No, absolutely. So, top line answer, you are the property is evaluated based upon its ability to be used for the purpose for which it was designed. So most of the time, that context is people build a new house and they try not to get the certificate of occupancy till after the 1st of January, but that's not the standard. We'll go out on the 1st of January, and if the house is substantially done, the air conditioner's there, the toilets can flush, and the only difference here is somebody's still got to do an inspection. It's going to go on the tax roll because it was substantially complete and able to be used for the purpose. So do the inverse of that. If you can't live there, then it's going to be classified as uninhabitable. And the way that it gets valued inside that bucket of uninhabitable just depends on its physical condition. So, we've got these 19,000 plus condos. Not all of those are destroyed, windows blown out, roof gone. A lot of those are complexes where all the mechanical rooms were washed away. The buildings are structurally sound. The interiors were not damaged, but there's no electricity, there's no elevator. They can't be occupied legally. And so they get, essentially we've tagged all those units with a $10 value for the period of time while they're going to be in that criteria. And then the rest where you have physical damage, we're doing something new. We have traditionally never, well, let me back up. In a condo, obviously, you're a fractional owner of the land and the building. Collectively, all of the unit owners make up the association that's the actual owner of the land and the exterior of the building. And because the units trade as the condo units, the easiest way to value it, the logical way to value it, is just compare the sales of the condo units. Well, we get a scenario, and we've got a lot of these, where you've got a 50-year-old, 60-year-old condo building that's had the roof blown off and the windows blown in. And the truth is, if that was a single owner property, that is a tear down building, and what you really own is 3 acres in the Gulf of Mexico, and you're a 1/80th share fractional owner of that land. So we are weighing what the physical condition, the likely financial feasibility of rebuilding is, and for all those that aren't, for all these properties where the condo is uninhabitable, we're turning around and trying to develop, we are developing a land value for those, and then pro rata breaking it back out to reflect. So there's not a zero associated with those. And the same thing is, it's trying to create a parallel context that you have in the single family context, where even if the house is uninhabitable, they still own the land still has value, and particularly in y'all's jurisdictions, the land is the majority of the value anyway, except for the most exclusive properties. We might get some parity, but by and large, on the islands, obviously the land is where the value's at. So that's not lost in this. That's still being captured for each one of those properties.
Matt, I'm confused. And so I'm just going to try to get some clarity here. You guys did a great job for 2022, and from the time of the hurricane to the end of December, people were able to apply for a refund, and they did, and they got checks, and that worked, and that goes through the end of December of 2022. There's been, as far as I know, no way to contact your office and say that one's house has been uninhabitable from, say, January till today, for example. They're rebuilding that. So you have 8 months of uninhabitability in your house, say on Captiva. What do you do? I mean, what should the homeowner do with that information? Is that where you say we have 25 days from the trim notice to advise the county that the house has been uninhabitable for 8 months, and then figure if there's some calculation that reduces taxes in relation to that? Or what is the obligation of the homeowner to do if they couldn't get back into the house as of, say, today?
Yeah, so that goes back to the basic premise of how we do the tax roll, and the fact that the refund last year is one of only 2 aberrations from the norm. So the norm is that you are assessed based upon January 1st. So regardless of what happens throughout the rest of the year, the other 364 days, what the condition of the home was, what the value of the home was, what the use of the property was on January 1st is what controls the way it's treated in the tax roll. So if it was uninhabitable on the 1st, even if they moved in on the 2nd, pretty low odds of that being that fine a condition difference, based on what I explained to Tony a minute ago about how we evaluate inhabitability. But let's just say, for the purpose of argument, that you were able to suddenly make it habitable January 2nd, you'd get the whole year based on the fact that it wasn't habitable on January 1st. And so let's think about a place where that really could happen, not absurdly, for those condos I just described, where you can't live in them because there's no elevator, there's no power. If they suddenly get all that shipped in and the contractor shows up on January 2nd of next year at this point, January 2nd, 2024, and fixes it all, they're going to get a whole year's uninhabitable because that still wasn't in place on January 1st. So that for all of 23, 24 going forward, it's all going to be based on their condition January 1st. That refund in 22 was a specific departure from this normal tax roll process that gave you a partial year refund based on post-storm damages. Now, how do they communicate with us? Well, trim is the time trim is really the notice this is your last chance for the tax roll. But it doesn't prevent you from communicating with us at any point before that. And so you see over here, the top banner on our webpage, and if people don't do that, they've always got the contact us. You can go to the live chat here. You can go to our contact us tab down here. You can call us, and you can come down and visit with us directly. If through any of those methods, they can let us know whatever's going on. So if you click here, it just opens up this page. Now, this has been updated since last December, when it just clicked open an email box, because we were in the very beginning. But this will be, if you check your tax bill, there's a specific alternate key there that you can click in, and that will help us if you use that, because it auto loads all of your information you give us, pictures, story, whatever, directly to your tax record. So we don't have to separately handle that in the background. But if you don't have this, you can still use the email and just tell us the story about your property, so that we can then go through and tag all of that information to the property in question. And it's, just tell us the things that will help us identify what property you're talking about and what are the issues that concern you as the property owner.
So just to be clear, so if you requested a tax refund for the 2022 and you received it through December 31st, 2022, from what I hear you're saying, there's really nothing more you need to do, because what the refund included was the assessment of the property at the end of the year, which then would be applied on January 1st, unless the tax office saw some change. And therefore, your trim notice would reflect that uninhabitability in this year's trim notice, is basically what you're saying.
Absolutely. At the risk of the exception, when you deal with big data, I'm sure there's a scenario somewhere in the set where we will have messed it up. But my instructions, and they've been clearly understood and implemented, is if someone qualified as uninhabitable through December 31st, we're going to classify them that way just January 1st, because there's no scenario they had resolved those issues in 24 hours.
That's very clear. Thank you.
Yep.
For those people that have damage, but their house was inhabitable, and they didn't claim a refund, those ones, we ought to go in and into the website here and hit that click here to report our damage.
It will make it extremely helpful for us. Now,
Okay.
if it was visible from the exterior, and I would say overwhelmingly the properties on the islands, there's a correlation between visible exterior damage and interior, right? Where we're worried we're going to have the most interactions is, for example, in the South Cape, where it was almost exclusively a flood event in all 60s concrete block houses. So we can't see from the outside that anything went wrong with it. But everybody who had exterior damage would have been tagged through that aerial review. But we're not, think about the scenarios, like, we could see that the shutters came off and some of your shingles came off, but we didn't see that, it blew up underneath your stilt house and blew out the underside and rained inside your kitchen for 2 days, right? That's the kind of stuff we need reported.
Got it.
Yeah. Hey, Matt, Jeff Powell here, Fire Chief. I know you're probably getting there, and just some of the questions that have prevented you, but can you just make sure we touch on the rollback rate and what these deletions that we've just had all this discussion about, kind of what that actually does? I know it's a confusing topic for everybody. I mean, I deal with it. I know how to do the math, and I understand the implication, but just what that reality is actually going to look like and not be totally reality, right?
Sure, absolutely. So the rollback rate is obviously the millage that's calculated by DOR to reflect no net change in taxes, in actual taxes, and it's an approximation, right? There's so many different things that change about each of our individual situations that even when you take a mass appraisal, you take all the value all together, and then you calculate losses and gains, and you come up with a new value, and then you reflect, how much taxes were last year, and so what's the millage that would give you that same amount? That would still not mean that when you apply it to an individual house, it will absolutely result in the same amount of taxation. But the attempt in how DOR has done it is to create that scenario for the individual taxpayers, and we never really had to challenge the theory of how the statute was assembled until the scale of this disaster. Even in previous ones, it didn't show up the way it did this time, just because of the scale of difference. But the rollback rate is attempting to replicate the same taxes, not for the jurisdiction, but for the individual taxpayers. So what that means in a scenario where, for example, just talk about Sanibel. Sanibel's lost 40% of its taxable value. Regardless of how DOR calculated its math, the net result means if you're going to collect the same amount of money this year you did last year, you're going to have to raise the taxes on the remaining 60% to make up for the loss of that 40%. And that dynamic, how much that the impact is of raising the taxes between those two, that's what the rollback rate is trying to capture. As the chief knows, it's not perfect, and they didn't do themselves any favors by developing a form that is confusing on its face, and you need to sit and go through a lot of mental gymnastics before you get around to agreeing that what they say they intend to do is probably what it is calculating, but it does it in such a confusing way that even I had to go back and have arguments with my staff for about 2 days before we arrived at conclusion. But the take home is the rollback rate is trying to capture the delta between what you captured, what you collected last year, and what you're going to have to collect this year from those taxpayers that remain. And in those jurisdictions where you have such an enormous loss of taxable value, you're going to have, as a result, a pretty big gap in the rollback rate. It's going to be eye-catching as it has been for many of the jurisdictions impacted that way.
Yeah, so to put that in perspective for us here on Captiva, so our operating value for the island is $1.7 billion, and then we had another $251 million worth of deletions for the island. It was about 250, use round numbers, 251 million in deletions, and then about another 8 million in additions. So that comes out 243 million is our total in deletions. So that takes the actual adjusted value up to 1.958 billion for the island. And that's what the rollback rate that we have to advertise off of is based off of. The anomaly comes in where he said we try and basically get the same amount as the previous year. As a taxing district, we only get to tax off of the 1.7 billion. So that leaves us with a big shortfall and almost 400,000 in actual revenue and proceeds to the district. So that's going to have us show on your tax notice and in the newspaper, that's going to show a 42.86% increase in taxes. But in reality, our actual budget is not increasing 42%. We're only increasing our budget itself by about 8% due to inflation, lack of reserves from the storm, damage, etc. So that was why I really wanted Matt to kind of explain it from his end, because I've explained it to myself, I've explained it to my board, and it's still confusing, and I look at these numbers on a daily basis. So I know as a property owner, if you get a tax bill or you read in the newspaper or the Islander that, hey, Captiva's raising the fire district taxes 42.86%, you're going to be like, what? 40%? It's a mathematical anomaly that we're looking at. As you said, it is going to be a shocking value. I will tell you, we're obviously not the only ones. He speaks as the county. It could definitely be worse. If you look, Sanibel's increasing theirs by 69%. They're right next to us. So, the important thing is just to try and convey as best as we can as a taxing district. And I know the CEPD is another taxing district. I believe they're on the call as well. But those deletions, that $250 million worth of deletions for the island is what that drives that percentage that you're going to see in that increase, which isn't 100% accurate. So.
Yeah, I mean, that's really the difference. In typical years, you can say, the change in the millage rate, whatever that ends up being, is going to track very closely to the actual difference in taxes paid by the property owners. But because of the dynamic here, you're going to have a much higher rate in order to collect the same, essentially, amount of taxes, even before you talk about the inflation question. And so, yeah, there's going to be a real perception delta on, how much your districts are spending versus what their rate has to be in order just to stay in operation based on how much properties come off. Now, the thing to recognize, obviously, is considering that almost half of the deletions are condos, and like we talked about with those condos, all those buildings that are structurally sound and able to be occupied except for the fact that there's some physical restriction, electrical, mechanical, etc. We expect to see a lot of that come back on in a pretty strong way January 1st. So for many jurisdictions, this may end up just being a single year event. Obviously, out on the islands collectively, it's more likely to be a multi-year event. But the other thing that's going to happen is we're going to capture in the January 124 tax roll all of this market activity that's occurring on the islands in 2023, and it's pretty strong, as everybody on this call probably recognizes and sees happening in the market.
But Matt, for a property owner who did not have damage, are you saying that he is going to pay significantly more taxes than he did the prior year because he has to make up for the deficit of what you're going to have? Because so many people aren't going to have taxable values, they're going to have very significant declines in taxable values due to hurricane loss?
If the goal of the district is to provide the same level of service, then that's what the net result's going to be. And so the only way around that, as individual districts, is obviously to look to the legislature to backfill that operating cost at the state expense rather than the local taxpayer expense, or basically reduce level of service. I mean that.
Yeah.
And my impression on particularly the two districts out there in Captiva, y'all don't have excessively indulgent service levels. So you'd basically be cutting off some level of operation in either of those if you didn't fully fund the operation.
Yeah, and I can tell you from a fire district standpoint, as Matt just mentioned, we have applied for multiple avenue streams of recapturing some of that revenue loss that we've experienced, some of the funds we've lost due to damage to the structure and whatnot. The unfortunate thing is none of those revenue streams are going to be funded or available or even really decided prior to having to set this year's budget and millage rate. So all those funds aren't going to come in until we've already started and set our next fiscal year. So, those are kind of unknowns, and they could end up being almost like he's saying is properties coming back online on valuations for next year. So this may be one of those years specific to Captiva where, this year might look rough. That percentage increase might look rough. Some property owners, may be paying more because of the deleted structures, but then come next year, as we all hope, all these come back online, and then, not to use windfall, but there could be then excess that can then help next year and then bring back in line with where we need to be. I mean, that's the overall goal and hope. But we have definitely looked at every other avenue as far as recapturing that revenue loss for the district.
Mm-hmm. Okay.
I have one question, Matt. One question came into me. I just want to ask if your structure didn't suffer significant damage that you could see, but the elevator is not working, and the only way you can get to your home is via elevator because of your own personal condition, and the elevator companies are really backed up, and it's going to take a while before they can fix these elevators. Is that something that they should report to you and basically explain that the home is uninhabitable until the elevator is fixed?
They certainly should report it, and we'll have to evaluate the situation. I think that the context, just my opinion, and taken for granted that it's been implemented consistently across the board throughout the whole tax roll. Under Florida building code, I think you can go to 3 stories, maybe 4 stories without an elevator. So clearly anything over that, if you don't have an elevator, isn't meeting building code. So that's an easy metric. If you have a low-rise condo, a 1 or 2 story condo, and everything works, the power all works, you can use the facility, there's no physical damage, the only limitation is the elevator isn't working, I would not classify that as uninhabitable, but there is an impact, because if you look at the valuation ratios of apartment complexes, condo complexes, where you don't have elevators, and so the marketability, the universe of buyers is obviously smaller for the upper floors. So there does end up being a price differential between those, and we'll need to reflect that in how we evaluate buildings that have a long-term loss of elevator in that circumstance. I hope that kind of broke it out for him.
Yep, thank you.
Matt, we have a couple of questions from the audience. I think you're typing to answer one of them. The one below it is, how does this work for commercial properties that were not fixed because they were getting insurance?
It works all the same. So obviously we spend most of our time talking in the residential context, because that's about 400,000 or 500,000 properties in the county. But the way you are evaluated is the same dynamic. Can the property be used for the purpose for which it was designed, and what are the challenges associated with it? That's why we really, on the reporting side, we have not been overly prescriptive with check boxes, et cetera, because we really need people to tell us their story and identify the things that every property's got some unique situation to it, right? I mean, there's obviously parallels, but we leave it open-ended so that the property owner can tell us what's going on with their property. So same dynamic. Contact us anytime. Use that portal. All the tax bills get that alternate key, as well as the direct email, and then all the regular ways to communicate, chat and phone and come in. And then the next one is, would having South Seas rebuilt and back operational help with the large deficit? Yes, that would be an easy answer. South Seas is obviously a huge chunk of the taxable value on the island, and the damage it's suffering from is obviously a big part of what you see reflected here.
Do we have any other questions from the audience, Ken?
One just popped up. Thank you for the answer. Will this be available for 2024? Should the home still be uninhabitable?
Yes, so the uninhabitability from an annual tax roll evaluation is always standard. So this isn't a reflection of just the storm. If anything happened to you, if you came home from Christmas vacation and your house flooded and the whole place is completely unoccupiable, because the hot water heater broke, you should tell us on January 1st, because you couldn't live there. And you should have that reflected in your taxable value for the year. So the evaluation for the normal tax roll process is always the same, regardless of hurricane circumstances or anything else. It's what is the ownership, value, and condition of the property on January 1st. That the tax refund, why I describe it as a aberration from the normal paradigm, is because it's just specific to the remainder of the year following a specific natural disaster that comes into play. But that closed, that refund statute only applied to those 3 months after the storm in 2022, and the window to apply for that closed in May of this year. So that all the refund work is done and closed, and so now we're only looking on a going forward basis at January 1st to January 1st. Next question. I haven't done anything about this whole tax issue. What do I do? Kathy, I would say if you can see the screen, if you're comfortable with chat, click there. You can go to contact us and call us. I'm assuming you don't want to drive all the way into town unless you already are. Feel free to stop by and visit with us. But you're going to get the same team. So this isn't some offshore group. It's the same 20 folks that you see in person at our public service area man the contact points as well. And they'll walk you through all the specifics regarding your individual situation, Kathy.
Hey, Matt, Jeff Powell again. Can you just touch on these properties that do have these deletions, whether it be a condo, single family, whatever it is on this tax roll? Let's just use single family home that was considered deleted on this tax roll. Say it's back fully operational as intended, all repairs are made come January 1 next year. How does that valuation come back online, and how does that correlate if it's a homesteaded property as well?
All right, so from the valuation perspective, we're going to use those same tools that we used to evaluate where the damage was. We're going to create a compare contrast, right? We're going to take the whole bucket of properties that are not fully on the tax roll this year, and those will be the first priority in the first quarter of 24 to go and evaluate what's their current physical condition. We'll use the aerial flight that will run hopefully the first week of January.